So, have you noticed what's been happening with Singapore REITs lately? Some of the biggest names are hitting their 52-week highs. Now, after a pretty rough couple of years, you have to wonder, is this the rebound we've been waiting for? Or should we maybe be a little bit cautious? Well, that's exactly what we're going to figure out today. Hey everyone, welcome back to the channel. Before we jump in, you know the drill. I have to share this super important reminder. This video is purely for education and entertainment. It is absolutely not financial advice. Please, please, please always do your own research, or better yet, chat with a licensed financial advisor before making any investment moves. All right? Great, let's get into it. For anyone who's new here, REITs are basically companies that own properties that make money, like shopping malls, offices, and even data centers. They're super popular in Singapore because they tend to pay out some pretty nice dividends. Today, we're going to look at 5 top-performing Singapore REITs that are right near their peak for the year. We'll break down what makes them tick, look at their pros and cons, and try to answer that million-dollar question: can they actually go even higher? First up, let's talk about the powerhouse of the digital world, Keppel DC REIT. This REIT is all about data centers, the buildings that power our entire online lives. And wow, has it been on a roll. Its stock price is sitting at $2.36, which is just a whisper away from its 52-week high of $2.40. So let's look at the numbers. It has a dividend yield of 4.3%, but here's the interesting part. Its price to NAV ratio is 1.5. In simple terms, that means investors are willing to pay a premium for it, about 50% over its book value. So what's the big deal? Well, 2 letters: AI. The demand for data centers is just exploding. Keppel DC REIT recently made a huge move, buying 2 massive data centers in Singapore. That deal alone is expected to give a nice boost to its income. It's no surprise that analysts are really positive on this one. The main thing to watch out for? Well, it has properties overseas, so currency swings can be a risk. And let's be honest, everyone wants a piece of the data center pie, so competition is definitely heating up. All right, next up, we have an absolute giant, the biggest REIT in Singapore, actually, CapitaLand Integrated Commercial Trust, or CICT. Think of Singapore's most famous shopping malls and office towers like Ion Orchard and Raffles City. Yep, that's CICT. And get this, it's trading right at its 52-week high, $2.28. That tells you a lot about what investors are thinking, right? The confidence is clearly there. Let's check the vitals. The dividend yield is a solid 4.77%. Its price to its NAV is sitting at 0.99, which means it's trading almost exactly at its book value. And its gearing, or debt level, is a healthy 38.6%. The growth story here is pretty straightforward. People are back in the malls and offices, which means occupancy is high and rents are going up. They've also been smart about buying great assets, which keeps the portfolio strong. So what are the risks? The big one is the future of work. With more people working from home, that could affect office demand long term. And of course, e-commerce is always a challenge for physical malls. All right, our third REIT is Fraser Centrepoint Trust. I like to call this one the suburban champion. This REIT owns a bunch of the suburban malls that people rely on for their everyday shopping. And it's trading at $2.33, which is super close to its 52-week high of $2.41. Now for the numbers. FCT has a really attractive dividend yield of 5.6%. That's pretty juicy. Its price to NAV is 0.94, so it's trading at a slight discount to its value. And its gearing is the same as CICT at 38.6%. Its strength? It's defensive. People need to buy groceries and daily essentials no matter what the economy's doing, and that's what these malls provide. Its occupancy rate is nearly perfect at 99.5%. Plus, it just finished upgrading its 10 Pines 5 mall, which gave its income a nice little bump. Analysts seem to love it. The challenges? Well, there's always competition from other malls, and if people start worrying about their jobs and spending less, even suburban malls can feel the pinch. Okay, let's switch gears to something really unique, the super defensive Parkway Life REIT. This is a healthcare REIT. It owns hospitals and nursing homes. Its stock price is $4.22, just off its 52-week high of $4.33. Now, its dividend yield is lower than the others at 3.56%, but what you get in exchange is stability. Its gearing is one of the lowest out there at just 35.4%. The magic of this REIT is its business model. Its properties are locked into super long-term leases. And even better, those leases have rent increases already built in. This means you can predict its income for years, even decades into the future. In fact, a massive 40% rent hike is coming for its Singapore hospitals in 2026. That's why some people call this one a rare jewel. The only real downside, if you're looking for high, immediate income, that lower dividend yield might not be for you. And finally, we have Mapletree Industrial Trust, or MIT. This one is a diversified player. It owns a mix of everything: industrial parks, business parks, and data centers. Now, MIT's story is a little more complicated. It's had a good recent run up to $2.09, but it's still quite a ways off from its 52-week high of $2.59. It does offer the highest dividend yield of the group, a very tempting 6.2%, but it also trades at a premium with a price to NAV of 1.23 and has the highest gearing at 40.1%. So here's the catch. Its Singapore properties are doing great, but it has a lot of properties in the United States. And because the Singapore dollar has been so strong, when it converts that US dollar rental back home, it's worth less. This currency issue actually caused its income to drop recently, and that's made investors a bit nervous. It's something the management is trying to fix, but it's a real headwind right now. Okay, so let's put that all together. What have we learned? It really feels like there's a flight to quality happening. Investors are rewarding REITs that have really strong, clear growth stories. Keppel DC REIT with the whole AI boom, and Parkway Life REIT with its incredible stability both look really strong. Fraser Centrepoint Trust is also a fantastic defensive choice for anyone who believes in the power of local shopping. On the other hand, you have a leader like CICT. It's a great REIT, no doubt, but since it's already at its peak, you have to wonder how much higher it can go in the short term. It could be vulnerable to a pullback. And then there's MIT, which has that big currency question mark hanging over it, despite its high yield. So can these REITs keep climbing? For some, I think the answer is yes, but you always have to remember the big picture. The entire REIT sector is tied to interest rates. If those expected rate cuts get delayed, it could be a bumpy ride for everyone. And of course, a global slowdown or currency swings are always things to keep on your radar. And for the last time, I have to say it, this is not financial advice. Please make sure you do your own homework before making any decisions. Now, I'm really curious to hear what you think. Which one of these REITs is on your watch list? Drop a comment down below and let's chat about it. And hey, if you found this breakdown helpful, it would mean the world to me if you hit that like button, share this video with a friend, and subscribe for more insights into the Singapore market. Thanks so much for watching.